We now come to the final parts of our discussion on capital gain of the taxation impact and capital gains and some other taxation implications that come up, and some of the interesting features that the income tax department allows us, or the government of India allows us, in terms of tax saving mechanisms. How can we actually save taxes by doing some simple investments in certain kinds of investments, or what are the various reliefs or sort of subsidies that are available when someone is actually calculating taxation, right? So one final section in terms of taxations is other incomes. We've already seen taxation from income from salary, income from house property, income from capital gains, income from business or profession. The final one is other income. If you put money in a bank, the interest that you get is taxable, right? Interest is not taxable up to 10,000. Any interest greater than 10,000 gets taxed, essentially, right? The any kind of gains that can come up, things like lottery, etc., also get taxed, right? So these are also essentially other incomes that get added to your overall taxable income. The detailed discussion on each of these headers is beyond the scope, so we'll not go there. But just remember that if someone wins a lottery worth 10 lakhs, there is going to be a tax incidence on that, right? So post tax, the impact could be significantly lower. So that's something that is important for us to understand. Uh, let's understand the concept of tax saving from the perspective of what kind of options are available. There are some nomenclatures for certain sections that the Income Tax Act allows us, and based on those sections, an individual can actually save some taxes. So let's understand this. There is a very, very common section called the section 80C. This is a very important section that comes up in your income segment, in your income tax calculations. And there is a limit of 1.5 lakh, total 1.5 lakh that is available for every individual. Up to this amount, you can avail a benefit by investing in either or all of these instruments. So if you invest in National Savings Certificate, Public Provident Fund, Employee Provident Fund, if there is some tuition fee for children, if there's some insurance premium, equity linked saving schemes, any bank FDs of tenure over 5 years, house loan repayment, only the principal part out of the EMI. Remember, the EMI is constructed out of EMI is made of principal plus interest, only the principal component, and any kind of pension plans that you have bought. All these payments up to a total of 150,000 or 1.5 lakhs, if you have invested, that's the maximum benefit you can get. What is the idea? If someone invests 50,000 here, 1 lakh is cut in employee provident fund, and someone invests another in let's say an insurance premium of 50,000, the total amount invested is 2 lakhs, but you will get a rebate of 1.5 lakhs. What does that mean? If your taxable income is 8 lakhs, you straight away subtract 1.5 lakh from that. You will only calculate tax on 6.5 lakhs, right? So that is the rebate that is given up to a total of 1.5 lakhs under only section 80C, right? There are other sections that are allowed. So for example, 80 TTA says till the time savings bank interest, the bank interest that comes to you, is less than 10,000, you don't pay any tax on that. You can avail a benefit of that. We don't need to remember the names of the sections. 80C is important because this practically applies to everyone. Everyone who gets a salary will have EPF. Everyone will have some insurance premium. Everyone will have probably a public provident fund open. Everyone will at some point of time have tuition fee for children. And at some point of time, people will buy home and there is going to be a principal component. Added all together, 1.5 lakh can be saved in taxable income purely on this. If someone takes an education loan, then only the interest paid on it out of the EMI, only the interest component, remember, only interest, and including any loan taken for dependent. So if I take a loan for my kid who's a dependent, all this can get cut from my total taxable income. There is no upper limit. So if the education loan is for foreign studies and I take a loan of, let's say, 50 lakh rupees, and in the first year there is a 5 lakh interest component on that, that entire 5 lakh will get subtracted from my income, right? So that is effectively the tax benefit I can get on education loan, interest on education loan. Any donations made to various charitable institutions under section 80G are exempt from tax. No upper limit here. You can, there are some institutions where 100% of the charity made comes for allowance. There are some where 50% of the charity made can get adjusted. Those institutes, those organizations typically outline. So for example, if you give a charity to HelpAge India, there is going to be a tax benefit of that charity that is done. The government allows you that tax benefit, right? Then there's something called section 24. We've already seen this, interest on home loan. Now we are talking about the interest component, not the principal. Principal comes here. Interest comes in section 24. If you are in a self-occupied home, up to 1.5 lakhs gets written off. That we had already seen in our discussion on income from house property. If it is let out, then the actual amount repaid, there's no limit essentially, right? That will get adjusted under section 24 when you're calculating taxable income. Finally, medical insurance. Medical insurance premium paid for dependents or self. Medical insurance premium paid for parents. So for yourself and spouse and dependents, 15,000 is available. For parents, another 15,000 is available if you buy. So this gets adjusted straight away. It gets knocked off from your total taxable income. It would be interesting if we try and use this entire discussion in terms of actually figuring out what is going to be the impact of all these using a few cases, right? Let's look at a couple of cases. So Ajay has a salary income of 9 lakhs. In addition to this, following details are available, right? Let's understand what's happening here. So there is 40,000 rupees we see invested 1,25,000 in equity mutual funds on 1st Jan 2015, sold this on 2nd Jan 2016 for 165, 40,000 rupees, but this is long-term capital gain, zero tax on equities, right? He invested 3 lakh in debt mutual funds on 2015, sold it for 320, short-term capital gain, 20,000 rupees gets added to the income. So income becomes 9 lakh 20,000. That's my taxable income because this 20,000 is short-term capital gain. Correct? So that gets added to income tax slab. Now we look at the next set of items. Invested in house property, rented out. Rent received 3 lakh per year. So 3 lakh gets added. And then standard deduction of 30% will get subtracted. Remember? So that goes out. The total EMI is 2.5 lakh paid. Principal component is 1 lakh. 1 lakh will come under section 80C. The remaining 1.5. The interest component is 2.5. Principal is 1 lakh. So interest of 2.5, it's let out. So the entire interest amount is deductible from the income. Correct? So that's your income from house property. These two will combine and give you the income from house property. Medical insurance premium 10,000 subtractable. So this goes down as well. EPF contribution 30,000. ELSS 30,000. These two combined are 80C, 80C. This 1 lakh was also 80C. So 80C limit gets hit. Maximum 1.5 lakh is allowed. We are at 1 lakh plus 30,000 plus 30,000 plus a term insurance premium. Under 80C, 169,000 has been paid, but only 1.5 lakh is allowed. The remaining is not beneficial. And he's taken an education loan on which an EMI is paid at 5,000 rupees per month. Interest component is 3,000 in this. Remember, only the interest component, as per this, only the interest on education loan is accounted for. So 3,000 will give me 36,000. There's no limit here. Let's try and put all this on an Excel file and try and figure out what is the actual tax incidence on this person, right? So we have income at 9 lakh, long-term capital gain equity at 40,000. So this will not get taxed. Short-term capital gain on debt at 20,000. So that's going to get added straight away, right? So total taxable income is going to be equal to 9 lakh plus 20,000, correct? I'm going to ignore the long-term capital gain on equity, and that's where I start. From this, we start building up the case on invested in house property, rent received is 3 lakhs. So rent is 3 lakhs. Standard deductions will be 30% of the rent received, remember that? And interest component on EMI, remember, is 2.5 lakhs. So we can subtract all of this. This entire thing could get subtracted. So let's find the income from house property. That's 3 lakh minus 90,000 minus 2.5 lakhs minus 40,000 will get subtracted. So taxable income will get subtracted, right? Let's call this A. Let's call this B. Let's see if there is any benefit in section 80C. 80C we saw was 1.5 lakhs, so we can fix 1.5 lakhs. So section 80C, 1.5 lakh goes there, correct? And then there was some medical insurance premium that was there as well, right? So let's call this C, let's call this D, medical insurance premium. That's 10,000, remember, right? Now, total taxable income is A minus B minus C minus D, and that's going to be 920, right? And in this case, income from actually A plus B, because income from house property is a negative number, so we'll do A plus B. So that's 920 minus 40,000 effectively, plus minus 40,000 minus 1.5 lakh minus 10,000. That's my total taxable income up to 250,000, zero tax. 2.525, there is a 25,000 tax incidence, and the remaining one is going to be 20% into 7,20,000 minus 5 lakh. That's my total tax. So total tax above 5 is 20%. This is 10%. Total tax is equal to 69,000. And on this, there is a cess of 3% into 69,000. So my combined final tax value is going to be 71,070, right? That's how we basically go ahead and calculate the overall taxation. So remember, tax, capital gains, income from house property, medical insurance, ELSS. Sorry, we also missed out a tuition fee here, right? There's an education loan, so we had missed out the tuition fee. So let's put E here, interest on education loan, and that's 36,000, and we have to subtract E as well. So minus E, correct? So I subtract 36,000 as well. Tax goes down to that amount, right? So if you have an education loan, that is beneficial in terms of your final income calculation and the tax that someone ends up paying at a certain income level. So that's something that is interesting that we have seen. Let's take another case very quickly. Susanne has a salary income of 13 lakhs. In addition, following details are available. Invested 150 in mutual funds on 1st Jan, sold this on 2nd November at a value of 2 lakh, short-term capital gains, straight 15% tax, right? This doesn't get added to slab and all. So I will put this, we will calculate this separately, right? How much is this? This is basically 50,000 into 15%. So that's going to be 7,500. We will add this separately. Land piece bought in 1st Jan 2012, 1st Jan 2016, 6 lakh. This has to be indexed. So we have to look at the indexation values. 20% of the indexed value has to come up. Invested in house property, self-occupied. Self-occupied interest component only up to 1.5 lakhs is allowed, right? Interest component was 2 lakhs, only up to 1.5 is allowed. Principal is 1.5. If principal is 1.5, 80C is taken care of. So insurance premium, EPF contribution, no value. This has no value. Term insurance, no value. Tuition fee, no value, because all of it is already included in 80C, right? What is valuable is medical insurance premium for herself up to 15K, parents 12K, entire thing is allowed, right? So 13 lakh taxable income, right? Minus income from house property. So 1.5 lakhs will get subtracted. So minus 1.5 lakh goes there. Minus 1.5 lakhs on, so this is whatever, this is on house property, this is on 80C, and minus 27,000 on medical insurance, right? Plus any long-term capital gain that comes on the land. So we can calculate the long-term capital gain on land. Let's try and calculate. This is 2012 and 2016. So here we go. 2012, the value is 785. 2016, the value is 1081, right? Let's go to our Excel file, and we are saying 13 lakhs is here. Long-term capital gain equity, there's nothing. Short-term capital gain is there. Long-term capital gain debt is there. We saw the values were 1081, 785. So cost is 3 lakhs, right? Let's calculate the indexed cost. That's 1081 divided by 785 into 3 lakhs. So that's 4.13. Selling price is 6 lakhs. So we get a total value of 20% of 6 minus 4.13. Remember, this is in lakhs, so I will multiply with 10 raised to 5. That's the total tax that has to be paid, right? I can again, that's the total, sorry, this is long term, so that's the total tax that has to be paid. We can actually just put this aside, and that's separate. We're not going to look at, that's the tax value that is going to come separately. So that's long-term capital gain on land, 20% of this, right? Then house property total deduction is minus 1.5 lakhs, correct? Section 80C is 1.5 lakhs. Medical insurance total premium 27,000. No education loan, nothing. So the total value that comes out is 13 plus 1.5 negative minus 1.5 minus 27,000. That gives me the taxable income. On this we can calculate the tax value. That's going to be 25,000. That's going to be 20% into 973 minus, sorry, we have to do a 973 minus 5 lakhs. And that's the total taxation amount. And to this, we will add both the short-term capital gain tax on equities, which is the 7,500 that came, and the long-term capital gain tax on debt or land, which came up, right? Everything else is not useful. So that will come up with the final tax amount on the entire thing. Put a 3% cess. We arrive at the value. Let's look at that actually. Let's calculate. So effectively, that's the total tax value is equal to the sum of this plus the long-term capital gain tax plus 7,500 for equities. And on this, we can straight away put a 3% cess. That's my total tax liability for Susanne. That's the second case we were looking at, Susanne's tax liability in this context, right? So that's how we basically go about looking at cases around income calculation, tax calculation. So some other points that we can explore is that taxation is a vast field. It is not possible to cover all aspects here, but some pointers on what lies beyond or what could be explored beyond this course are given. Capital gains on property sale can be avoided by investing the gains in another property, right? So if I have a 50 lakh gain, I bought a land piece for 50 lakhs, sold it for 1 crore, that 50 lakh gain, if that is invested in another property, I don't need to pay capital gains on that, right? That has to be done within 6 months. That comes under section 54 of income tax. Important because people make money there. There are various cases which come with income from house property. You have to check with a chartered accountant as to what happens, right? Such as part of the home. There are 5 stories or 5 floors on the home. You stay on 1 floor and 1 floor is rented out and 3 are vacant. Then you have to arrive at these details to figure out what is the exact component that interest component that can get adjusted from the EMI, right? Income from trading in derivatives is treated as speculation income, gets added in business income, right? Tax saving rules keep changing every year. Ensure that you check the income tax slabs and rules. So ATC limits can change, slabs can change. It is important for you to check these every year. Every year, these are typically announced in the union budget, right? If there is any change to these rules. If you stay in a rented home, you're eligible for in certain cases for house rent allowance. Now you don't buy a home, you stay in a rented home. If there is an HRA component, house rent allowance component in your income, you're eligible for that. Then that allows you for some reduction in your taxable income. Again, exact rules should be identified before making any advice. But if you figure out that an individual is living in a rented house, then there could be a possibility of some taxable income going down because the house rent allowance is a part of his or her salary, right? Any gifts made to blood relatives and spouse are not taxable. So if someone makes a gift of 1 lakh rupees to mother, his or her mother, that's non-taxable. But if you make the same gift to a friend, that's added to the income of the friend, right? If you make the same gift to a friend, if you transfer money to a friend as a gift, that's added to the income of the friend. But if the same gift is made to a blood relative, mother, spouse, or kids, then that is non-taxable, right? Those are some of the nuances. There are obviously hundreds of other points that are there. We can't cover everything under taxation, but it's important to know some of these concepts that come along with it. With that, we come to a broad end of the taxation segment that we wanted to discuss. A couple of questions to end this. Explain some of the instruments which come under ATC. What is the limit for section ATC for any individual? Explain any 3 financial decisions that aid an individual to reduce the tax liability. Hint here, this is on the tax, saving section that we had just discussed. Thank you.